This is Charlotte Talks. I'm Mike Collins. At the close of the market yesterday, stocks were up, but only slightly. The Dow was up 152 points. The Nasdaq rose 1.7%. The S&P 500 gained 1.07%, led by tech stocks. And yesterday was the first time since December that the S&P closed above 2,600. That's a key level watched by traders. Things might have been slightly better were it not for negative reaction to the British Parliament's decision to reject Prime Minister Theresa May's Brexit agreement with the European Union. Who knows what will happen today? Much of last year was a roller coaster ride with extreme highs and lows reaching to depths not seen since the Great Depression, fueled by uncertainty over interest rates, trade agreements, and world affairs. And in the first 2 weeks of this year, the market has repeated last year's bumpy ride. If you have a broker, he or she has probably told you to stay the course, and he or she is probably right. You can't time the market. But that doesn't mean you aren't nervous, and it doesn't mean you shouldn't be keeping an eye on things, particularly if you plan to live on your investments in retirement. We invited a couple of market watchers to share some of their thoughts this hour to tell us what they see when they look at Wall Street and whether or not the bulls are still running or if the bears are racing down the street. Caroline Hudson is here. She is a financial reporter for the Charlotte Business Journal. Welcome to you.
Thank you for having me.
Very welcome. And she's in our Spirit Square studio along with Tim Quinlan, senior economist at Wells Fargo. Welcome back.
Good morning.
Good to see you. How would the two of you characterize what went on in 2018? What did your readers seem to want to know about what was happening as this thing was going up and down wildly?
I'll go ahead and kick it off if that's okay.
You're the one with readers. I don't think he has anybody reading.
You might. I read your stuff. Don't worry. You've got one reader. I would say the main thing that our readers wanted to know last year was, when is this bull run going to end? Mm-hmm. And of course, that is a question that no one really knows the answer to, which is frustrating for a lot of investors and shareholders especially. So I think the 2018 was, of course, a year of high growth, I think around 3% for U.S. GDP, and things were looking good. And I think that made people very nervous about when this was going to turn around and what they should do to prepare for when it does turn around. And I think people began to get nervous, especially in the second half of 2018, and that's only going to continue in 2019, I think, as predictions start to shift.
What were your impressions as you watched this for Wells Fargo and others?
Well, I think by any reckoning, you're getting into late innings here. I mean, when you kind of back up and say, when have we been at this point in prior cycles? Only one other time have we had an economic expansion that's lasted this long, and that was in that run between 1991 and 2001. If you go by months, it was actually exactly 120 months. We're going to hit that number in June of this year. If we make it to July without a recession, we've broken the record, making this the longest uninterrupted.
I thought we'd already done that. I thought we'd already broken that record.
You broke it in the equity markets. So it's the longest equity market bull run. The economy has yet to match that.
And are you saying that because the last time we had a market bull run as long as this one has been was just immediately prior to the Great Recession, and we all know what happened when that happened, and is that making people more nervous that we've had this extraordinary run, and my God, when it ends, and it will end because they all end, it's going to be a disaster, and that scares people?
I don't know that that's necessarily a fair characterization of it. I think that you look at three different players in terms of how we'd react: households, businesses, and the government. I think that the first two of those, households and businesses, are in as good a shape as they've been in the last 20 years or so. They're pretty well positioned to absorb at least a mild recession. The government, on the other hand, after having narrowed the budget deficit for 5 or 6 consecutive years, has kind of reversed course more recently. We're running bigger budget deficits. Historically, the longer an expansion goes, the smaller the budget deficits you had. We mentioned that 1990s bull market before. By the end of that period, the government was running a modest budget surplus. And according to estimates from the CBO, we're going to be at $1 trillion budget deficits by next fiscal year.
So two questions. What was the driving force? Was there any one factor that caused the markets to be so erratic last year and what we've seen so far this year. Is there any one thing or two things that you can point to, or is it just the vagaries out there?
Well, I would say it's never just one thing. The markets in themselves are very volatile and very sensitive
Not
in
like
general.
this. Oh my God.
Right, and it's of course amplified. I would point to maybe two or three things that come to mind for me. First of all, of course, the uncertainties with trade wars started by the Trump administration. Obviously, a lot of those have since been mostly resolved. We're still looking at China right now and wondering what's going to happen. I think that definitely played a role. Also, as we mentioned earlier, the Federal Reserve continues to hike its benchmark rate.
Right.
I believe it's between 2.25% and 2.5% right now. And there were either 4 or 5 rate hikes in 2018, I believe, and that's expected to slow down this year. But of course, when those rates go up, so do other rates in the market. And that starts a question of, okay, is this going to put the brakes on the economy? What effect is this going to have? And so I think those couple of things in particular have really colored what's happening right now.
Let's talk about some technical things for a second. Why has this bull market been so long? Because usually they're much shorter than this. What has been causing this to be so expansive?
Well, interestingly, I think that question can kind of be tied back to Caroline's last answer. She's right in saying that the Fed raised rates 4 times last year to take the Fed funds rate to 2.5%. And the question now is whether or not they should continue normalizing interest rates, continue raising rates as we go forward. And the duration of these economic cycles, it's not a coincidence that 3 out of the 4 longest expansions have been since the 1980s. And that really comes because of what Paul Volcker did in the early 1980s, establishing the credibility and independence of a central bank. He was able to break the back of inflation in those years, even though the actions he took put the economy into the twin recessions of the early 1980s. But the global financial system accepted the U.S. dollar as the reserve currency of the world and the Fed as a credible central banker, and that's sort of allowed us to manage these economic cycles and extend the duration and end the boom-bust cycle that characterized growth in the immediate post-World War II era.
And let's talk about recessions. Why do we all? It's an up and down cycle. We have bull markets, we have bear markets, and they're not the same as the economy. But nonetheless, we have recessions. Business expands and it contracts. Why? If we're growing and growing and growing and growing, why don't we just plateau for a while? Why does it have to go down?
Well, at a conference just last week, actually, 2 former Fed chairs and the current Fed chair were sitting together. So Janet Yellen, Ben Bernanke, and Jay Powell. And Bernanke repeated kind of a thing that economists like to say, which is expansions don't die of old age. But he added his corollary to it, which is they get murdered. And that means, there's somebody does something stupid. You get some kind of, reckless risk taking in some part of the economy, or bad decisions in one area or another that cause to an excess. And that ultimately is what the catalyst is for recession.
There's no algorithm that can fix that? Take it out of human hands, let the computers do it?
I think that might make it worse, Mike.
We talk a lot about the stock market, and we get worried about the stock. Average people sometimes get worried about the stock market because their 401ks are invested a lot in stocks and other things that are traded in open markets, and they're going to depend on that. So we worry that the stock market goes down. But when the stock market goes down, it doesn't necessarily correlate to a recession. And vice versa. We could have a recession and stocks may not have been dipping that badly. There's no correlation whatsoever? None?
I would hesitate to say that there's no correlation. I do think the stock market is, of course, it's very, I guess the shareholders react before something happens, if that makes sense.
Yeah.
So in that way, you can kind of see what's happening in the industry, but on a temporary basis. So at this point now, yes, it is oscillating like crazy, but we are still technically in a bull market.
Right. Has there been a correction? I mean, we've had these tremendous dips, but the next day they seem to come right back. So would you call that a correction? And what is a correction? I want to define some terms that we hear all the time for people who hear them and think they know what they are, but may not.
So generally, a correction is a 10% downdraft in equity markets.
How long does it have to last? Can it bounce back tomorrow and still be called a correction?
All it needs to do is touch that point, and
Okay.
it's there.
Okay.
A 20% downdraft is kind of a working rule of thumb for a bear market. And then you say, well, how long does it have to last? Are we still in a bear market? That would be whether or not we're still more than 20% down from the pre-crisis peak. We have technically entered into both correction and bear market territory. And with the volatility that we've seen since December, we've now moved back out of bear market territory and are kind of flirting with that correction area. But I guess what I'd say around all this is Warren Buffett's mentor was Benjamin Graham, and he said the stock market in the short run is a voting machine. In the long run, it's a weighing machine, which is kind of a way of saying that, from day to day, month to month, even quarter to quarter, you can get a lot of volatility from speculation and ins and outs, but ultimately long-term valuations define it in the long run.
So what is long-term?
Well,
How do you define long-term? Is it 5 years, 10 years, 20 years?
I think it depends on your risk tolerance and your time horizon. I think if you're talking about retirement, it's got to be over a period of several years. If your idea of long run is 6 months, you probably shouldn't be in the stock market.
So if you're looking at peaks and valleys and you're timing it from a certain point in time, is everybody timing it from the end of the Great Recession or the point when the stock market began its rise away from the depths of the Great Recession? That's what we're timing it from?
I would say, there's an old expression, it's time in the market rather than timing the market. I'm not smart enough to time the market. I've never known anybody who repeatedly can time the market. I had an early mentor that used to say, you got to think of it like a guy walking up the side of a mountain with a yo-yo. And the yo-yo goes up and down, but over time you're making progress higher and gaining altitude.
And that's a great analogy. And that is what's been happening, right?
Yeah, absolutely.
Since the market is way up. It's almost astoundingly up from where it was in the Great Recession. But at the end of last year, the market was slightly down. So is that just like a little blip in the mountainside? We're still going up the mountain, but that's just a tiny little, not even a valley, just a little, and then up we go again. Is that what that was?
Well, I'd like to offer an analogy as well. From my perspective and talking to business owners, financial advisors in my line of work, most people would still characterize it as a weaker bull market, I would say.
Okay.
And so in my mind, I view it as almost, it's not a charging bull. It's a walking bull, and that bull's a little bit uncertain, and I think the bear is definitely looming.
He's grazing.
He's grazing.
Taking some time to take stock of things.
Exactly. That's how I like to picture it in my mind anyways.
So we're gonna talk a little bit more about that as we go through the hour. We'll bring up the R word, which is recession, and we'll bring up the I word, which is inflation, because that's what the Fed looks at, and the Fed is the central bank that Tim Quinlan referred to a little while ago. Tim Quinlan is here. He's senior economist with Wells Fargo. Caroline Hudson is a financial reporter who writes about this and talks to all these people every day for the Charlotte Business Journal, and we'll take a little break and come back with more in a moment. Charlotte Talks on WFAE. Support for Charlotte Talks comes from WFAE members and the Jazz Arts Initiative, presenting Tenor Madness, 5 tenor saxophonists together for a 3-day celebration of saxophone masters, January 17th through 19th at the Blumenthal Stage Door Theater. Tickets at blumenthalarts.org. And the new Asbury Health and Rehabilitation Center at Aldersgate, a shift from institutional care to neighborhood living. Details at aldersgatehealthcare.com. Well, tomorrow on this program, we explore the puzzling discovery that the city is short of money for the Cross Charlotte Trail. After 6 years thinking that $38 million would do the trick, they suddenly realize we're $77 million short. What happened? Well, we do a little digging tomorrow with people who should know. find out if they do. Then singer-songwriter Cy Khan, who is an activist, talked about his new musical about Mary Harris Jones, the most dangerous woman in America. Both tomorrow at 9.
Keep calm and carry on, a popular slogan for the British in World War II. How's that working with Brexit? More than 1 million Americans work for British companies. What does Britain leaving the European Union mean for those workers and for America's relationship with Europe? Next time on 1A.
That conversation coming up at 10 following Charlotte Talks with Mike Collins on 90.7 WFAE, Charlotte's NPR news source.
It's Charlotte Talks on listener-funded 90.7 WFAE and 90.3 WFHE. I'm Mike Collins. We're talking about the market and the economy with people who watch it every day. Tim Quinlan is here. He's a senior economist with Wells Fargo. Caroline Hudson is a financial reporter for the Charlotte Business Journal. If we slide into a bear market, and we've touched it and come back out of it, but if we slide into it for any period of time, does a recession always follow?
It needn't necessarily follow by default, but what often happens is a big sustained bear market will eventually weigh on both consumer and on business confidence. And at that point, you get into a little bit of a self-fulfilling prophecy.
So you're saying if we have a recession, the market may go down?
Well, I specifically, I was saying, you said is if there's a decline in the stock market, need that necessarily result in a recession? And I'd say if stock prices remain depressed, that has a tendency to weigh on consumer confidence, then people don't go out and spend as much and the economy starts to slow.
Okay. So one doesn't necessarily follow the other, but it could.
Yes.
Okay. And what are you hearing, Caroline, from folks that you talk to every day about their worries concerning a possible recession?
Well, I think it varies a lot based on where you stand in the market, because on the one side, talking to consumers and just the everyday people who might be investors, they are extremely nervous and wondering if they should pull out of the market already. But then on the flip side, when you talk to, as I mentioned earlier, those financial advisors, investment managers, wealth management, any of that, they are all across the board saying, don't pull out of this. Yeah. You know, it's not time yet. The sky is not falling, even though it could very well fall in 2019, 2020. Now is not the time. And so one person I talked to recently described it as these fears are overblown. Yeah. And I think that is very true from their perspective.
When you hear people talk about the market or even sometimes the economy, it sounds like they're talking about sports because they bring up the word fundamentals a lot. The fundamentals are good. And for a while they've been saying that the fundamentals are sound, and they're still saying that. Forbes says an optimistic investor can focus on strong U.S. economic data and healthy economic fundamentals, despite the chaos in Washington. Last year, the U.S. GDP jumped above the 3% range, with strength in manufacturing, service industries, transportation, all boosting corporate profits. U.S. consumer spending was at record levels. How can this be anything but good news? How can we have these gyrations in the market and the fear that they induce when all of this is good news here?
Well, again, I don't think that the average person necessarily thinks about GDP, more of those macroeconomic things. They are just looking at a statement.
Right, but the average person does not drive the gyrations in the stock market. These are institutional investors, people who should know better.
Well, if you're looking for somebody to bring down the mood, it's a good thing you invited an economist. I can tell you that you know it is true that in 2018 we had two individual quarters in which GDP growth grew faster than 3%. But looking at our forecast for 2019, at no point do we see the quarterly pace of GDP growth ever growing any faster than 2.5%. Mm-hmm. So in that regard, some of our best years are behind us in terms of the pace of growth.
And those best years were prior to the Great Recession.
Well, that's a longer. I meant just in this cycle, but
okay,
yeah, you raise an interesting point in that, because we were in the 50s and 60s we were putting up 5-6% growth easy, but there were fundamentals, as you discussed in your comment earlier, were really different in those years. With the baby boomers were reaching their working years, that drove a really faster pace of labor force growth. But face it, I'm one of 6 kids. I only have 3 future workers of my own. As we all have smaller families over time, the ability to grow the labor force has diminished a little bit. So you have to kind of lower your expectations a little bit in terms of the pace of growth.
Last year, corporate profits grew what was, I think, the New York Times described as massively in the first 3 quarters of the year, expanding by at least 25% in those time periods. Is that sustainable? And if not, do markets get troubled when they witness 3 consecutive quarters of massive growth, and then suddenly it doesn't grow that fast anymore? Because what goes up must come down.
Well, the short answer is no, it's not sustainable. But it was engendered by tax cuts and a dialing back of the regulatory environment. You're not going to do those sorts of things again. And so that creates kind of a more difficult base upon which to build future corporate profit growth.
So if we had massive corporate profits last year, or if corporate profits at least did well over the course of 2018, does that mean they will not do as well in 2019? And that will cause people to worry, to fret?
Well, I would say people are always going to worry and fret no matter what. Even when the market's great, they're always looking toward the next thing and when this cycle is going to end. I would say, from my perspective, I think that corporate profits will still do well in 2019. Now, compared to 2018, maybe not so well, but everything's relative, and so you have to pull back and look at it on a longer term basis to really get an idea of what actually is happening here.
Forbes also says, quote, a pessimistic investor can legitimately worry about global geopolitical and economic uncertainties coming out of Europe, trade tensions with China, slowing global economic growth, and a hawkish Federal Reserve Bank raising interest rates. Which stance should a wise person take? Should they be a pessimist or should they be an optimist?
Well, I would say both.
Tim?
Both or neither. How about that?
Okay.
I don't think you should be, I think you should keep things in reality, and so keep a close eye on it. However, again, as I said earlier, the sky is not falling yet. Things are doing great. The economy in the U.S. definitely is growing. And so I don't know what the term is, but somewhere in between. You have to have a balance.
At the risk of talking to someone who may get it wrong a lot because he's an economist.
Ouch.
It's really, those are fighting words.
Which should we be, pessimistic or optimistic?
Right, yeah.
Which should we be, a pessimist or an optimist?
Well, let me give you a couple specific numbers so you can kind of frame your thinking and make your own call on it. So you talked about corporate profits. After-tax corporate profits for full year 2018 grew 15.9%. It's about the fastest growth we've seen at any point in the last 15 years. Our expectation for 2019 is after-tax profit growth of 4.1%. So that's a really big slowdown. Now, part of that reflects the tax cut. So if we just look at before-tax profits, that was 7.7%. Admittedly, it's still a really good year, but not nearly the 15.9. And that also is expected to slow, but only to 4.4%. So corporate profits are coming off, but it's the after-tax corporate profits that are exacerbating a little bit. You talked about the Fed, and we had 4 rate hikes last year. As recently as November, financial markets were baking in an expectation. There was a debate of whether or not it'd be 3 or 4 rate hikes during this calendar year, 2019, and that has really been dialed back a lot since then. In fact, financial markets, to look at where futures are trading, don't think that the Fed is going to raise rates at all.
Right.
Now, we still think that there are 2 rate hikes on the calendar for this year, and the fundamentals for that are framed by the Fed only has 2 jobs: maximum employment, low and stable inflation. Both of those seem to be more or less, where they need to be, which says that the Fed ought to be raising rates.
We're going to come back to the Fed. There's also fears about slowing growth in China. I know it's the second largest economy in the world, but why should we care about whether or not they are growing or shrinking in their economy?
Well, as China goes, so goes a lot of emerging markets. And if emerging market growth begins to slow, this can kind of be a little bit like a boomerang and come back to hit us. So you might think, Well, no, I don't think that that's true. I remember 1997 and 98 and the Asian contagion and the fallout in emerging markets, and it wasn't really that bad. Those were actually pretty good years for U.S. economic growth in the stock market. And what I'd point out is that exports to emerging markets at that time were maybe 25% of overall exports. Today, that figure is north of 50%. More than half of U.S. exports are going to emerging market economies, including China. Mm-hmm. So we root for their demise at our own peril here. If things slow globally, eventually it weighs on our exports.
And just days ago, Forbes said that equities have been behaving like a recession is looming, but they quickly added that dire outlook seems overdone. And they still said they said they still expect healthy returns in 2019. Do you agree? Stock market returns?
Well, Warren Buffett says, I have no idea what the stock market's going to do a month or a year from today. I don't know anything that he doesn't know. I can tell you what I'm expecting in terms of economic growth, and that is a moderation in the pace of growth. The days of 3% growth are kind of behind us. If that translates in investors' minds into lower equity prices, then that's how.
Is that permanent? Because of what you just said about the baby boomers and people having.
Yeah, Mike, I think to some extent it is. I mean, there are measures that we could take to offset that. So if labor force growth is slow, you could liberalize immigration policy. That seems unlikely in the current political climate.
Aside from being greedy, because if your economy is growing, you're making more money. One would presume. What's wrong with slow growth? You don't make as much, but then you're not paying out as much. You're not selling as much, but it's not costing you as much to make goods. What's the problem with slow growth?
Well, I mean, I would say there's nothing inherently wrong with slow growth. It's still growth. I think when growth does slow down, however, it brings people back to what happened in 2007 and 2008. And for a lot of people, that is still very raw and real to them. And so I think, really.
That wasn't slow growth. That was the collapse of the banking system in the economy.
Exactly. And, it's all relative. And going back to uncertainties in China, I mean, the U.S. has had the world's largest economy since the late 1800s, I believe. And so our economy was worth, and Tim, you can correct me on this, about $20 trillion in 2018. And so when you look at it that way, China seems like a drop in the bucket. Right. I mean, my point being that everything is relative.
Okay. Let's talk about the situation in China. There have been and continue to be trade tensions between the United States and China that seem to be influencing investors and therefore the market. Are these tensions largely driven by President Trump's policies and by the specter of tariffs that may inexorably alter trade between our two countries, or is something else at work? Is it the fact that China seems to be slowing in its growth? What's going on here?
Well, I mean, China's growth began a slower trajectory almost 10 years or so ago. Around 2010, President Hu at the time deliberately asked the country's largest banks to scale back lending. You had a big expansion of particularly business fixed investment spending that was engendered by aggressive lending in the banking sector, and they knew that was unsustainable. So they went from growing at, say, 12, 13% a year to growing at more like 7, 8% a year. So that the first stage of that slowdown was a intrinsic, domestic Chinese situation. The recent downdraft, where you've seen purchasing managers' indices drop into contraction territory, the stock market's there really starting to sell off meaningfully. I think you can trace the catalyst for that back to trade tariffs from the United States.
And let's talk about the Fed a little bit more, too, because during the Great Recession, the Fed lowered interest rates to zero, pretty much. Mm-hmm. Money was free for the banks, et cetera, and they had to do that because they wanted to restabilize the economy. But they also used every tool in their toolkit that they have to do the two main jobs that you talked about a second ago, Tim. So don't they have to raise rates at some point? I mean, they have to go back up because if we hit some financial crisis in the future and they have nothing left in their toolkit, they can't help fix it, correct?
Well, to some extent, that's correct. I mean, so for every rate hike that you are able to implement during the good times, it gives you more room to lower rates when the next crisis comes along. But as you pointed out, by 2009, we had gotten to zero in the Fed funds rate, but Bernanke was far from done with monetary policy easing. Through quantitative easing, the expansion of the Fed's balance sheet, and I can tell you want to ask another question.
No, it's okay.
They expanded the balance sheet, bought a bunch of treasuries, bought a bunch of mortgage-backed securities, all in an effort to kind of drive investors a little further out the risk curve, provide financing to the business sector, and that worked largely. And so the first step was just winding back the quantitative easing and then gradually starting to raise rates. So now we're at 2.5% on Fed funds. The voting members of the Fed say that they're not going to take rates much higher than 3% or so in this cycle, which tells me we've only got a couple of rate hikes left in this cycle.
So it seems wise investors, presidents of companies, et cetera, they know this. They know that the Fed is going to do this, that they have to do this at some point in time, that they probably saw it coming because the economy has been good, the stock market has been rising. Now it's time to maybe tighten it up a little bit because they're afraid of, maybe the Fed is afraid of inflation. Isn't this all priced in? In other words, when interest rates rise, that does hurt home buyers. It does hurt the mortgage industry. It does hurt home builders. It hurts cars because most people get a loan to buy a car and interest rates are higher. Hurts people who have to buy on credit because your credit card interest rates go up. That's all known, but isn't that also factored in to how people view markets, period?
I would say yes, it is factored in. When you talk about CEOs of some of the U.S.'s largest banks, Brian Moynihan, Tim Sloan, Jamie Dimon, I mean, they are built to operate in multiple economic scenarios. And, I mean, even once a year, they undergo stress testing to see, can we stay viable if the worst happens? And that's just an example of these are businessmen, and they understand economic cycles.
So when the president rails against the head of the Fed for doing bad things to the economy because they raised interest rates and are considering doing it again, what is that? Is that a lack of understanding about how the Fed works, about how the economic system works, or is it simply a tantrum because it's going to hurt his political options?
I would
serious question.
Absolutely, and I think people are often taken aback by Trump because he is so public-facing in his rants and what he has to say. We all know, right there on his Twitter all the time,
Sure.
No matter what he's doing, and I think that makes people very nervous. Past presidents may have had similar concerns, but they didn't necessarily let the public know about that. And I think that's the difference here. He has no filter.
Is that another factor in what we experienced last year? The public, he has no filter, and whatever is on his mind, he puts on Twitter, and that scares people because presidents don't do that? Is that playing into the gyrations in the market?
Well, I think definitely, because President Trump is not a politician in
Right.
how we view what politicians should be. He's very much a negotiator. And so I think,
I'm not sure that's accurate.
well, he would say he's a negotiator. How about that?
Yeah, he would.
And I think by putting out these ideas, he is trying to play the field and see how people are going to react, how he can finagle it, and again, that makes everyone nervous, including the markets.
Caroline Hudson is a business writer, financial reporter for the Charlotte Business Journal. She is here along with Tim Quinlan, senior economist for Wells Fargo. We're coming back. There's another segment. Don't go away. Charlotte Talks on WFAE. Support for Charlotte Talks comes from WFAE members and the North Carolina Turnpike Authority, offering NC Quick Pass transponders for automatically paid tolls when using the I-77 express lanes between Mooresville and Uptown. Details at ncquickpass.com. And the Charlotte Symphony. Christopher Warren Green leads the night of Russian masterworks, including Rachmaninoff's final composition, symphonic dances, and Prokofiev's third piano concerto. January 25th and 26th at Night Theater. Info at charlottesymphony.org. Well, Theresa May's Brexit deal went down with a stunning defeat, the worst in modern history in Parliament yesterday, setting up another no-confidence vote for the Prime Minister and what to do about Britain's exit from the European Union. With just over 2 months until Britain leaves the Union, what's next? They talk about that in 20 minutes at 10 o'clock on 1A with Joshua Johnson. And we will continue looking at the market and what it doth portend in a moment.
Today's morning routine was just like yesterday's. Same toothpaste, same breakfast. But what was happening in the world outside your door was anything but ordinary. Progress, unrest, lives changed forever. Every weekday starts out the same until you listen. Turn on Morning Edition and the world will open up before your ears in a way that opens your eyes. Start every day fully awake with Morning Edition from NPR News.
Tune in weekday mornings from 5 to 9 on WFAE.
It's Charlotte Talks on WFAE and WFHE. I'm Mike Collins. Caroline Hudson is here from the Business Journal. Tim Quinlan from Wells Fargo. As the Fed raises interest rates, we start to get back to where interest rates, maybe not quite to where they were, but we start to go back to where they were before the Great Recession. So that would be called getting back to the old normal. Can we get back to the old normal without causing a panic among people?
Well,
It used to be this way. This is what it used to cost, money.
it used to cost a lot more, actually.
right.
I mean, you've got Trump railing against the Fed because we're at 2.5%. We talked about Volcker earlier. Before he was finished with his tightening cycle in the early 1980s, the Fed funds rate was 20%. Can you imagine if we even got halfway to that, what the administration's reaction might be? But in each cycle,
I had a
since
mortgage in the 80s that was 18%.
that was probably good credit in the 1980s, the early 80s. That was a rate you bragged about, I bet.
It was painful.
But in each cycle, the Fed has kind of raised rates to, the terminal rate of Fed funds in each cycle tends to be a little bit lower than it was in the prior one, meaning, we've got a long-term downtrend in interest rates. And that seems to be consistent again in this cycle.
But the Fed only considers raising rates when they look out at the economy as a whole and see healthy signs. They saw economic growth. Obviously, if they appeared concerned about the rapid nature of growth in the economy, and that would cause them to think, inflation, and maybe raise interest rates to cool things off a bit of that. Is that what they're seeing? Are companies seeing that? Are major investors seeing that?
One of the hallmarks of monetary policy in this cycle has been the breakdown in the Phillips curve and the fact that even though we have a low unemployment
The Phillips curve
rate,
is what?
Even though we have a low unemployment rate, it's not translated into big wage gains, big income gains. So it's a tight labor market, and yet we don't see the labor side really benefiting from it until recently. We're finally now seeing wage growth pick up in a meaningful way. Leading indicators like the Atlanta Fed's wage growth tracker are climbing closer to 4%. So we're finally at a point in this cycle where we're seeing wage push inflation. And that has been getting the Fed closer to its 2% target, and that's been kind of the rationale.
This may surprise a lot of people who take home a paycheck, that wages are 3.2% higher than they were a year ago. Who knew? I didn't. And experts say that they are cautiously optimistic about growth in the coming year. Are wages going to continue to come up a little bit here and there throughout the next year?
Well, I think it's basic economic principle. I mean, when you do have that tight labor market, companies are now starting to compete for those workers that they're having such a hard time finding. And a way to compete is to raise wages. And, I think it has the potential to continue in the next year from what I've seen.
And talking about labor, the labor force participation rate, which I didn't know till yesterday, was the measure of workers coming off the sidelines and going back to work, rose. Are you sitting? It rose 63.1% in December. Was that temporary? Was that seasonal employment? Or is that a harbinger of things to come? People getting back into the job market?
Well, participation has been another kind of weakness of this cycle. So you might remember Chairman Bernanke saying, well, we'll begin raising rates when when the unemployment rate drops below 6.5%. And we got there really quickly. And he said at the time, the reason for that is the unemployment rate overstates the health of the labor market because of what you're describing, Mike. The participation rate wasn't as high as it could be. as the labor market improves and gets a lot stronger, it's drawing people back into the labor market who had kind of given up looking.
Right.
So it's a healthy dynamic to see participation up. But you could get me to take a jaundiced view of a number of facets of the economy at the moment. But the labor market is absolutely white hot. I talk to business owners every week that say, I can't find the workers that I need. If I can find them and they can pass a drug test,
Right.
they want to get paid more than my best people are already
We actually
making.
talked about this about a year ago with restaurateurs in Charlotte. They're having trouble getting people to work in the kitchen and wait tables because there are other higher paying, more steady jobs out there right now. That was a year ago.
Right, and I think also you have to consider the level of skill in the labor force. Finally, there are jobs for people that match the skills they possess, and that's also another reason why they are coming off the sidelines, I would say, because they're finding jobs that match with their skill set, their education
Where were those
set.
jobs before? Why are they suddenly popping up, appearing? Seriously.
Well, I think one reason is in this cycle now, we are adding jobs. I believe we added.
So companies did without because they just couldn't afford it before the situation began to improve? I just don't understand the concept of suddenly these people have been on the sidelines now for years because there were no jobs to match their skills. Today there are. What happened?
I mean, I don't think companies necessarily did without. I think there were just fewer people.
In Ernest Hemingway's The Sun Also Rises, one of the characters is asked how he lost his fortune. And he says 2 ways, gradually and then suddenly. And I think that's really what it's been in this cycle. We've seen monthly job growth on the order of 200,000 or better since around 2011 or so. And then, as that draws people back into the labor force, people take the jobs that they can get at first, and then eventually they take the jobs that align better with their skill set. And, a faster pace of hiring in the last year or so makes it feel a little bit more sudden. But this has been a gradual build.
So there are 800,000, close to a little over 800,000 people right now not getting a paycheck because they're government workers because of the government shutdown. How will an enduring government shutdown impact the economy and the market? And should investors be concerned about, particularly those who are depending on this money for their retirements, should they be concerned about the impact this shutdown might have on them?
Well, I would say that they should certainly pay attention to the impact that this is having. I would say, so there's 2 sets of what could happen if you're a federal worker. Either you're on furlough and you're not coming into work right now, or in the case of, say, TSA agents, for example.
You're working for free.
You're working for free right now, although you will be paid in retrograde, but for now you're working for free. And so I think the longer this continues, the worse the impact on consumer confidence.
Because I think Bank of America and other banks have already made concessions to
Yes.
people who are impacted directly by this by not
Yes.
getting a paycheck. So that means they're being affected, which
Right.
means their vendors will be affected. It's a trickle-down cycle. This is trickle-down economics that actually does work.
Let me give you some hard numbers on this. In 2014, the OMB, the Office of Management and Budget, the U.S. government basically said that shutdown cost $2.5 billion. That was a 16 days in duration shutdown. So, we can take $2.5 billion, divide it by 16 days, and that gives you $156 million a day. So you take 156 million times the 26 days that we've now been shut down, and that's just over $4 billion. Now, as a share of a $20 trillion economy, that's, only about 0.2%. But, you annualize that, which they do in the GDP reporting, and it could be a pretty significant
Is
drag.
that money that's gone forever, or is this that money will be recouped later on when people get their back pay and start paying their mortgages and their car payments that they had to skip because they didn't have any money coming?
Sure. I mean, these furloughed workers that have been going without a paycheck will eventually be made whole, but there is going to be a lasting contribution to the economy because if you were, planning on an overnight for a kid's soccer game or going out to dinner, you're not going to go out to dinner twice or take 2 nights in a hotel to make up for what you missed. Right. So there's a lasting impact.
What impact would a damning report from Robert Mueller have on the economy and on markets? If one that would implicate the president or members of his family in collusion with Russia, with election tampering, with obstruction of justice, of being an agent of a foreign power, which are all things that have been speculated, what would that impact be?
Well, for better or for worse, the markets do respond to things happening with politics. It's just the way it is, either globally or here in the U.S. So,
What happened after Watergate? Anybody? Both of you are far too young to have any personal knowledge of this from a
I'm
first-hand
a millennial,
point.
Mike. Don't
But, I
ask
mean,
me about.
After Watergate, when the
I'm a Gen
president was-
Xer. I can at least answer questions about what happened during Clinton's.
There we go.
But he stuck around.
Right.
Right.
What happened after with the Clinton situation?
Financial markets actually absorbed it rather well. I mean, it was at each. Think of the man walking up the side of the hill with the yo-yo. At each announcement, every time Ken Starr walked in front of a bank of microphones, the cameras switched to the New York Stock Exchange, which actually had traders on it in those years.
Right.
And we'd have maybe a day or two sell-off, but eventually they'd kind of resume to trend. If you're talking about the removal of a president, which at least Nixon had the dignity to resign before it came to that. If you talk, I don't savor the position of guessing what President Trump's going to do, but I wouldn't expect him to go out gracefully based on previous things that the way he's conducted himself. So that could be a wholly different thing for financial markets.
Ken Fisher, who is the founder and chairman of Fisher Investments and the author of 11 New York Times best-selling books on business and finance, wrote a column for USA Today, and in it he said, "I was way too optimistic in 2018. That makes me even more optimistic for what's ahead. When most folks expect bad news, stocks usually shine the following year. I see stocks rising 15 to 25% or more in 2019. To quote the Christmas song, do you see what he sees?"
I'll take the under.
You think it's going to be under that?
Yes.
Why?
Well, let me first say I don't speak on behalf of Wells Fargo in terms of forecasting where equity markets are going to be. I'm not a stock guy. I'm an economics guy. But, over time, since 1925, large cap stocks have averaged between 10 and 11% per annum. We talked earlier about how economic growth in the 50s and 60s was characterized by this really strong breakneck pace, 5-6% GDP growth. We're not going to have that kind of growth this year. We're not going to have that growth at any time in the next decade or so. Sure, you may have one-off quarter here or there where trade or inventory lifts the pace of growth, but on a sustained basis, 3, 4, 5% GDP growth just isn't in the cards for us.
So if Ken Fisher is optimistic, one would assume that his people who work for Fisher Investments are telling their clients that we're optimistic about the market, and maybe you should be too, given everything we've talked about, market conditions, the economic conditions, China, President Trump, government shutdown, rising interest rates. How should people in the market, particularly after last year's gyrations, despite the man walking up the mountain with the yo-yo, how should they be positioning themselves, Caroline?
The short answer is it depends. And I think you have to look at your investment individually based on where you are in your life. I think Tim touched on this earlier. If you are closer to retirement, you need to give a hard look at what stocks you're investing in, maybe pull away from those that are more volatile than others, such as technology. If you have a longer time left to invest, again, across the board, people are telling me, stay in it because you have to stay in it to win it. That's the phrase they love to use.
Which is easier to say for a young
Absolutely.
person. So, yeah.
Absolutely.
John in Matthews emails, my 401k rose nicely from 2008 through early 2018. As soon as trade war action started, I started shifting from stock market index funds to T-bill index funds and interest-earning accounts before the big drop late last year. Being close to retirement age, I am not inclined to ride out another recession and strange politics with my money in the stock market.
Right. And those
And
are.
you would agree with that?
I would, yes.
At what age?
At what age? That's a good question.
Clearly, somebody already in retirement, 5 years facing 5 years before retirement, at age 50, at age 45.
I would say definitely if you're 5 years out, to take that path. Maybe 10. There's no set answer because everyone's different, but I would say no more than 10.
Of course, we're in this bull market, and if you pull your money out, you're missing out on all those. This is the thing about timing the market. You can't.
You can't.
And you miss out on all those gains. And even if you get out on a dip, then you're selling at a loss, and you're also going to miss out on the gains, but you may miss out on future losses. So it's really hard to come up with anything. We've been in this bull market since March 9th, 2009. So it's the longest stock market, bull market in history, I think. But we went through the worst December ever in the market. And late last year, there was an interesting headline on CNN. It said, "The longest ever bull market is near its end, or it might not be."
Brilliant.
That sums it up, I think.
So what is a mother to do
Right.
with that information? There have been rules that we've been advised to follow when it comes to investing, depending on our stage in life. Have they changed at all, given the different kind of president that we have, and given what's going on in the world economy, and looking at Brexit and what we went through in the market last year? Have those rules changed, or are they still the same?
I would say they're largely still the same. I mean, you're right. Christmas Eve was, I believe, the worst day for the stock market in U.S. history, which is nothing to discount or sneeze at. However, when you look at stocks today, I mean, although S&P 500, for example, the Dow Jones, when you look at the last month, they are on the uptick. And so that just shows you can't really determine something that quickly, and you can't predict what's going to happen.
The Great Recession was caused in great deal because some banks that were too big to fail did. And now we're looking at companies that might be too big to fail, like Amazon, Apple, Facebook, Google. Do we have too many of our economic eggs in those baskets? Are we depending on those companies too much? And I only have 15 seconds. Tim.
When 5 out of the 6 largest market cap stocks are technology firms, I think that one industry is overrepresented.
But they're completely different technologies. Amazon is very different from Facebook. Apple's very different from Google.
You said I only had a few seconds, Mike.
Okay, you bring up a good point, and I'll let you buy on that. Tim Quinlan, senior economist with Wells Fargo. I'm a bad guy. Caroline Hudson, financial reporter for the Charlotte Business Journal. Thank you both for the hour. Appreciate it.